Hello, this is Jordan. This video is being recorded on Thursday evening, July 21st, 2022. Thank you so much for joining me. Make sure you like, comment, and subscribe to the channel. I am going to be publishing as many video analyses as I can over the coming days and weeks because I think it's such an important time for not only gold and gold stocks, but also the stock market. And, I did a video or two talking about the bear market template, especially looking at significant bear markets. And, what I define those as, or looking at history, there's 6 that stand out. And basically, these 6 bear markets are part of the 3 secular bear markets in history, at least if you go back 100 years. So you have 1929 to 1942. There were 2 major bear markets during that period. Then you have 68 to 82. If you're looking at the S&P, you have 2 bear markets, although you kind of had, you had the double dip recession. So you kind of had a third there. You did have a period where there was a 20% decline, I think 76 or 77. But anyway, and then you have the 2000 to 2009, where you had the 2 bear markets. So if we're looking at secular bear markets, what's really interesting is they form a similar pattern where you have these 2 major bear markets, and then towards the end or at the beginning of the secular bull, you kind of have a mild bear market. And so if you look at, there's 29 to 42, but there was also 46 to 49 was a mild bear market. And so in real terms, 1949 is when that major bull market started. And in real terms, we could say 82. But as I said, there was, you had a 20% decline, 76 or 77. Then after 1980, I think you had a 25% decline, something like that. So, during a secular bear, you have 2 major bears, and then at the end, you have a mild bear. And we saw that in the last secular bear, the mild bear being 2011, when you had a 20% decline then. And then, of course, the market really took off. But so that's how that's what happens in secular bears. And I mentioned that because that's what we could be going into. And so there's 3 secular bears, and so each one has 2 major bear markets. So over the last 100 years, these 6 have been the worst bear markets, essentially. And what's interesting is if you look at all of them, they all rallied back and tested the 200-day moving average at some point. And it happened not even that deep into the bear market. Because other than 1929, the real big decline came after. The real accelerated decline came after the beginning. It came after the market tested the 200-day moving average. What's interesting is in 29, you had the crash, but the market still had this huge rally back up to the 200-day moving average, and you still could have gotten out. So if you're in a major bear market, one that's, and by the way, if you look at mild bear markets, if we're in a mild bear market and we're still in a secular bull for stocks, the stock market cannot make a lower low. It cannot go any lower. This rally has to carry up and make a new high for that to stay on track. So that's important. Obviously, I don't think that's going to be the case. I think the probabilities favor us being in a new secular bear market. And so we would expect the market to follow this template. And again, all of these nasty bear markets, they decline around 20% or so, 22%, to begin with on average. The 29, of course, was worse. But then they rally back up to the 200-day moving average. And that's really your last chance to really get out of stocks. And so looking at these 6 bear markets, I'm getting to the point here after babbling for 4 minutes, but looking at these 6 bear markets, the average time of when they rallied back and tested the 200-day, that was 7 to 7.5 months in. And we're a week from now, we are going to be a full 7 months in. So, and as you can see in the last couple of days, the last week or so, S&P rally, it's gained a little bit of steam. It looks like it has more upside. And so that's what we can be expecting potentially based on history is maybe the S&P, this bear market rally, can go up to the 200-day moving average. So in this, and by the way, I'm using a weekly chart here that allows me to cram in as much history as I can in one image, so you can see it fairly closely. So this is a weekly line chart, but I'm using the equivalent to the 200-day, which is the 42-week moving average. And so looking at, and I'm not looking at 29.37, those bears. I'm looking at 68, 73, and then of course 2000 to 2007. And I mean, there was some action the late 70s and the early 80s, but so I included those. But if you can look at the highlighted portions in the arrows, if you look closely, the stock market rallied back and failed at the 200-day moving average. So this works really well in significant bear markets. And look, even in 1977, it worked in 80 and 81, which weren't the worst bear markets. So the real test is going to be, what happens after this rally, because if it fades and rolls over again, you're setting up for a nasty decline in a real nasty bear market where it's going to be a 40%, 45% bear market. And then in that scenario, when you roll over, the Fed's going to be cutting and gold is going to be threatening to break out. So that's why this is significant for us precious metals bugs. But so, yeah, the 200-day, it's around, I think, 4,300, but it is coming down. So I haven't looked exactly where it might be in, 2-3 weeks or so, but it's going to be lower. S&P is just about at 4,000. So it has a little bit more upside. And so I'm zooming in here, looking at some history, and this is what I didn't show in the last chart. So 1926 to 46, and then you can see the 200-day moving average or the weekly equivalent. Look at the arrows. I mean, that's what I was talking about. 1929 crashed, rallied back up to the 200-day, then it failed. It even almost got back up to the 200-day in 1931. I should have labeled that. But then 1937, that 1937 to 42 to me was probably the worst bear market, because the worst cyclical bear, because number one, it was the longest. Number two, it fell apart really quickly. Look how quickly it tested the 200-day, and then it just crashed after that, 1937. Then even in 1940 and 41, it retested the 200-day. So, guys, look, when you're in a bear market or you think you're in a bear market, the 200-day moving average is resistance. And, the other key moving average, which I love using, is the 40-month moving average. And the reason is, not only is it significant with gold, it's significant with the stock market, because in this chart, by the way, it's a weekly chart, but I'm using the equivalent to the 40-month, which is about the 167-week moving average. But the reason it's important is because when you're in a secular bull market, the 40-month moving average tends to provide support for severe corrections. And so that's what the arrows are showing you. Look at 1954. Look at 1958. It went a little bit below. 1962 went a little bit below, but came back up. And then the market started to have trouble with the 40-month. 1968, the market declined below the 40-month. It went on to make a new high in the early 70s. But in real terms, the late 60s was really the peak. It was underperforming commodities and gold stocks badly, and gold as well, into the early 70s. Then again, you're back in secular bull territory when you look what happened in 1979 to 80. The market was holding above the 40-month. It went a little bit below it in 82, but look what happened. 87 crash all the way up to 2000. It held above it easily 3 times there in the late 80s to mid 90s. And look what's happened recently. Aside from the COVID crash, the market has held the 40-month moving average. And that's exactly what happened in the last month or so, or the last several weeks. I'm sorry, I don't have the zoomed in thumbnail here, but if you just pull up another chart, you can see the 40-month moving average. That's exactly where the S&P bottomed. And so, when you're looking at history, and we're looking at these significant bear markets, which I've circled. You can see the 6 circles. Those are the nasty twin bear markets that you get in secular bears. Remember, you have two based on the last 100 years of history, and so I circled those. And just look how it acts in relation to the 40-month moving average. You know, the market it came down and it bounced pretty close after the crash in 1937, it just fell apart, so there was no bounce there. But if you look at the other ones, 1968, you know, it struggled for a little while, then lost the moving average. If you look at 73, the S&P, it rallied above the moving average before really falling apart. Same thing happened in 2000, 2007, those bears. You can see when the stock market loses the 40-month moving average, that's when you're in a real significant bear. So this is really significant over the coming months. If, you know, number one, is the market going to rally up and roll over at the 200-day moving average at 4,300 or maybe a little bit lower? That's going to be your first really negative signal. And then number two, eventually, is the market going to go below the 40-month, which is, we can round up and say it's about 3,700. And, you know, I think I talked about this in the last video I did, which is obviously significant for precious metals. But, I mean, if this history plays out here, market rallies up to the 200-day, rolls over, gold's probably going to bottom at that point. The Fed, market's going to be discounting the Fed pausing and shifting. And then if the market, S&P, eventually loses the 40-month moving average, then you know they're going to be moving to cuts really soon. That's when gold should explode higher and challenge a breakout. So I know I've talked about this in past videos, but I wanted to update this just because it looks like the market is following the historical template. And listen, the next 3, 4, 5 months, I mean, the rest of the year, this could be really exciting because we could see some real shifts here. You know, the stock market potentially confirming that it's in a new secular bear, while at the same time, the Fed shifts policy. We get a huge rebound in precious metals, and then we'll see if gold can make that breakout and start its new secular bull market. All right, that was a long video. I'll continue to update this historical view as necessary when there's new developments. Thank you so much for tuning in, and I'll talk to you guys again in the next video.